Hi everyone, welcome to the Navigant Credit Union Broadcast Center. I'm GoLocal News editor Kate Nagel. Thanks for tuning in for 4 o'clock. 3 o'clock was Laura Afonso with food. We've got news and politics for you now. I'd like to welcome my first guest, Jeff Mortimer, the Director of Investment Strategy for BNY Mellon. Thank you for coming in today.
Sure, my pleasure.
Well, I appreciate having the opportunity to have you here in studio as you're in Providence because you're usually Boston-based. So what brought you down today?
I am doing some client events tonight at the University Club and looking forward to that, and wanted to stop in and say hello.
Wanted to stop in, have you come in and give us a little sense of what you think as the market is going to do with this year's midterm elections. Here we are, it's August. We constantly see fluctuations in the press, mind you, but even the last couple days with what we've seen with Cohen and what we've seen with Manafort, you know, has the market, did they really take this into account, or, you know, are we seeing some sort of resiliency? Bring you a little closer.
Sir, the market takes everything into account. The market is a discounting mechanism that is taking all current information and trying to figure out what impact that has on price. The good news for this is that the market already had some of this embedded in it.
Okay.
So even though you had the issues that came up yesterday after the close, you see that today's reaction was quite muted. I think we've just recently closed in the markets. I think we were roughly flat. So in other words, the market had some indication that these verdicts are going to be handed down, potentially, and even the guilty plea. So the market's good at estimating and guesstimating.
Okay.
So, but it is new information, and it may turn, again, either red wave or blue wave is what the market is still trying to figure out.
Okay. So you say pretty much that there's kind of rational actors. They kind of envision this coming, so there were no spikes or volatility with yesterday's.
And I would even go so far as the market has already discounted the most likely outcome of the midterm elections, which is that, in my opinion, and what I've read by other strategists within the marketplace itself, is that the market is already discounting that the Democrats take the House and that the Republicans hold the Senate.
Okay.
So if to talk existentially, if that were to happen in the future, the market wouldn't react at all. So think about that. It's already been embedded in price. If something different from that happens, I think you'll get a much broader market reaction. And I've written about this in the past. If Republicans were to hold the House, markets may rally because maybe more stimulus comes. If the Democrats were to take both the House and the Senate, perhaps the market retreats a bit as impeachment talks and other things may come to the forefront.
So you had posted an article several weeks ago talking about historically going into elections and presidents. And one of the more interesting facets is historically how presidents start their administrations. Historically look to inflict a little fiscal pain. This is not what we've seen with this administration.
That is right. Trump has front-end loaded his presidency. Certainly.
Wait, is the fiscal pain to come?
That's possible, right? Who knows? It is interesting where presidential cycles, most often the midterm election, the second year of the presidential cycle is the weakest, and the summer before the midterms is even seasonally a very weak period. So you sort of come out of that basement and you move up into, you know, a very good year in the third cycle, a third year of the presidential cycle. Trump has sort of stood that on its ear by injecting fiscal stimulus into the equation at the end of his first year, December 22nd. And markets are sort of off to the races. So we'll have to see how long that holds, how long that persists, or if he's got something else up his sleeve, potentially infrastructure build or something like that.
And so we're talking domestically here. Let's talk about the role of sort of international politics, if you will, not just you know, from an IR perspective, but you know, the tariffs. I mean, how much does what Trump tweet and what Trump direct really have an impact, and what do you anticipate? So
tariffs certainly would have a biting impact on markets if markets believed that they would be permanently inflicted. We have to remember that the tax reform of late last year, 2017, introduced some $800 billion or so of stimulus into our economy. The tariffs so far, if everything sort of announced were to take place, would take back about $120 billion of that in tariffs. So you're still at an 8-to-1 ratio of stimulus to tariff. The market is still trying to determine how much of those actual tariffs will perhaps bite and how much is instead being used as a negotiating tactic by this administration to the rest of the world to try to get fairer trade on behalf of the U.S. So far, the market's belief is, and what it is pricing in, is that things will end okay, that things will end all right, and this is bumps along the road that a lot of people are not taking time to sell, but sort of holding pat and even buying into, because some even think, and I've read this from others, is that we could end up in a better place than we are today with freer and fairer trade and lower tariffs overall. So the market really is trying to figure out all those things all at the same time.
Well, as we're trying to figure out the direction of the administration of President Donald Trump, we actually had the head of the Rhode Island Center for Freedom and Prosperity in here not too long ago when the second quarter results were made public. And I asked him, well, if you're such a free market guy, what do you think of a president who is engaging in such a tariff warfare? But to hit the nail on the head, it's mostly politics to try to keep some of our allies and others in line, if you will, and as you said, you think the markets have responded accordingly. So let's just back it up a little bit here, and I know you say that the market's anticipating potentially what happens in the midterms, and even knowing or anticipating what happened yesterday with Cohen and Manafort, but just that sort of looming, the Democrats, what they're harping on too, could this be the slippery slope down to impeachment? If that were the road that Congress were to go down, would it have an impact? Or as you said, the market's really, kind of hedging against that already?
Awfully tough to impeach. Again, it's very difficult to impeach any president. Remember, Clinton was impeached, but pardoned eventually, I think, by the Senate. I mean, Nixon was clearly impeached and then resigned. So it is very rare to do that. Markets are certainly not pricing that in. It would be interesting if he were impeached, who would take his place? Perhaps Pence takes his place, and perhaps it's seen by the market as a softer Trump, and the market could even rally on that news, right? So it's very, very interesting to think about, what does it mean and how would it end, which markets are constantly trying to do. And although that would be initially, I think, political instability, I don't think it then means that we enter recession and the economy, goes in the hopper. I think markets are rational. Markets thrive on profits and the multiples that they pay for those profits. And as long as the backdrop remains favorable, I think this market will continue to remain amazingly resilient until our next recession comes. And I think that's inflation. That's because of inflation. I think inflation is the important variable that the market is really paying attention to.
Okay.
Inflation comes from two things. It comes from wage pressure. We're already seeing certain wages and harder to hire workers. Certainly, I think Providence is among the cities in which I think a lot of business owners, entrepreneurs are finding it hard to find actual help. Unemployment rate incredibly low. That puts upward pressure on wages, of course, all else equal. The other thing that puts upward pressure on inflation is certainly bank lending and velocity of money and turnover of money. And so I'm monitoring those things very closely, and both remain very well behaved for this late in an economic cycle. Markets have, today is the anniversary, or today actually this market now passes and becomes one of the longest on records of a bull market run.
Wow.
So it's been uncelebrated. It has not been a sort of an appreciated bull market. A lot of people I think are underinvested in this tape, unfortunately.
Okay.
But I think we have, until we get our next recession because of higher inflation, I think we have probably another 12 to 18 months at least, of which a market I think that continues to grind higher and remains incredibly resilient in spite of some of the things that are, even over the last couple of days. Turkey, right, a week or 2, 3 weeks ago, even those things are thrown at it, and market's amazingly resilient at being able to withstand some of that things. Valuations are still reasonable, and I'm not bullish or bearish innately. I just continue to see sort of a decent fundamental backdrop underpinning this market. That'll eventually go away. It's not going away yet.
Anytime soon. Well, I was gonna say, are you bullish? And you said not innately, but
not innately.
Not innately.
Not innately. I want to be right. I want to give our clients the best advice that I can. Been doing this for 30 years, and separating really, signal from noise. That's what I'm always attempting to do.
Well, speaking of clients, you've got clients to go see here in Providence, but I'm
Yes.
so glad we were able to pick your brain a little bit for the benefit of our viewers
My
here in
pleasure.
the studio. So Jeff Mortimer, I'll let you go off to the races.
Thanks.
And don't go anywhere. We're going to come right back here with our next guest in the Navigant Credit Union Broadcast Center.